I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today is June 22nd.
And today we're going to be talking about mortgage rates. Where are they? Fed predictions. Where are they going? We've had some big movements. History of the Fed funds rate and how it correlates with the mortgage rates. And also forecasting where will mortgage rates be. This is one of the best slides we probably have ever had. So let's go.
All right. Remember, this is for informational purposes only. This is not financial advice. And this show here is for real estate agents right here, particularly in Arizona, where we serve, we're licensed in the state of Arizona. We serve primarily borrowers in Maricopa County. We focus on purchases. We're mortgage brokers right here. But this information, again, for you, we want to give you a really good quick update with where mortgage rates are today, but also go into these details.
And have it come from some really good guys.
Yeah, good guys.
Who else do you want to get this information from?
All right. So the 30-year fixed we see today at 6.87%, the 15-year fixed at 6.25.
The 30-year FHA is 6.55, and the 30-year VA is 6.54. Again, VA and FHA are always like neck and neck.
This is the Mortgage News Daily. It's an index. They basically take a lot of the lenders' rate sheets and average out where those rates are coming out at.
Yeah, through the country.
Yeah.
Through the entire country.
And as mortgage brokers, our rates really are. We're so very proud of our rates being, in most cases, like 0.25% lower than the most bankers out there, and the Fairways of the world, the guaranteed rates, and Nova Home Loans.
Yeah, and the reason why we're actually showing these rates is because we need a baseline that we can show you that if you pull up a newspaper, we'll be very, very close to that. If we show you our rates, which we have done in the past, it's going to be a little bit lower. But this is a good metric that we can use every time you listen to us. This is what the country is seeing.
Okay, so the 10-year yield is also a very good indicator, or probably the best indicator for where mortgage rates have been and where they're going. The 10-year yield is moving and trading at every trading second, right? When the markets are open, when equity markets are open, the 10-year yield is moving around. And right now, if you've watched the channel before, you've seen these two green lines here that I drew. This is a daily chart, and from November 2022, the 10-year yield hit a high. That's when mortgage rates hit their high. And then it started coming down. And into 2023, again, it kind of stair-stepped down. And
just like everything stair steps up, stair steps down. Nothing's a straight line.
Right. So what you'll notice here is that there's two lines. The top one is called a resistance line. The bottom one is a support line. Now, this is technical analysis, more just kind of elementary technical analysis, but it's really, really, I think, very straightforward. These are not rules that the markets, always follow, because what will happen is these are just lines that I put on a chart, but technical analysis can kind of discover kind of movements. And we see the 10-year yield, which is the reason why we're talking about the 10-year yield is we're talking about the 30-year fixed mortgage, for example. We believe it's hit this resistance line, and it's holding. This resistance line right up here is holding. And right now, if it continues to hold, we'll see rates come down. If there's something in the economy that high inflation, big jobs are coming to the market, if the economy starts revving up, we'll see the 10-year yield go through this line, and interest rates are just going to go back up, and we don't know how high if they go above this line.
If they do, we're just hoping a little bit.
Yeah. So the Fed rate and mortgage rate since 1982, this actually says 1982, but the chart itself, I actually updated it back to 1971. 1982 is where we see the peak. That's where interest rates were at the highest. The Fed rate was at the highest. And in red, right here, in red, you will see the 30-year fixed mortgage rate, the history of it. And the blue line is the Fed rate.
Yeah, and I don't know how often we've said this, but there is a mover, and the mover is that 10-year bond. Call it like the parent and the kid. The parent is the 10-year bond. The kid is going to be the mortgage rates, and they just simply follow. They don't follow, lock and step exactly, how they move, but as you can see, they definitely follow each other. And there are bigger gaps when that bond is coming down, and there seem to be, tighter, smaller gaps, when it goes up.
That's right. So they really do move. And of course, the 30-year fix is moving all the time. The Fed rate doesn't. It doesn't move as often. It'll be flat sometimes for 10 years, like it was between like 2009 and between 2009 and 2016. That was the longest period of time of no movements. But anyway, there is so much to learn there. Here's the gaps that you can see how those gaps increase and decrease over time.
And what we're saying over a historical perspective, it's about 2%.
Yeah.
If you're to look on an average going back all the way to 1971.
That's right. What's the Fed rate? And then add 2%, and that would be the average 30-year fix. Okay, so kind of right on that point, today's Fed rate is at 5.25. And Jerome Powell and the whole committee has been talking a lot. And we've been hearing, all of us, right? You've been listening to the news. You've been hearing about the Fed rate and inflation. So right now we see that the next meeting is July 26th, and it's anticipated that there's an 80% chance that it will go up to 5.5%, up a quarter. Mm-hmm. So you know what? So this red arrow here is this red arrow is incorrect. This red arrow should be this column just to the left, because
right now we're in that 500 to 525.
Yes, today's rate is that 500 to 525.
And it is tough. I've always thought about that. They don't give you like the exact number. They just give you a range.
Yeah. So
we're still kind of in that 525, right? But no, it's 525 to 550 is what it's going to be projected to be next July or this coming July.
Yeah. So in a little over a month, we should see potentially rates another 0.25% higher. And remember, these numbers from the CME Group, the Chicago Mercantile Exchange, this is from the futures markets. These things move daily.
And when you say futures, I mean, it's literally like being at Vegas, and you have people sitting there, throwing bets down.
Yeah.
What's the rate going to be? What's the rate going to be? They will move. I don't know if it moves hourly or if it's just daily. But these are constantly moving.
This updates maybe a couple times a day, or it's only maybe only a couple times a day. But the CME market is moving all the time. But they just probably don't update this chart in real time.
So come July 26th, when the Feds make their decision, which likely it looks like they are going to increase 25 points, this Chicago Mercantile Exchange is basically saying for the next 4 meetings, it's not going to move. And then after that, come the end of the year, they're going to start reducing it. And that's what everyone's waiting for. They were wanting that reduction to happen sooner, but inflation has been a little more stubborn than they were thinking.
So January 31st, 2024, that's when they see the first chances of really a lowering. Mm-hmm. The rates really lowering. And then all throughout 2024, it just kind of goes down a little bit, a quarter at a time, where at the end of 2024, so this is about 18 months from now, we would probably see the Fed rate at we're really right at 3.75 to 4%.
Yeah. Okay. Look. So if there's a 27.7% chance that it's going to be 375 to 400, how about take the 26%?
Yeah.
It could very well be 350 to 375. That's only 1% different or 1.5% different. And then if you keep going too, I mean, the point of this graph, which is awesome, is look at where all the zeros are. That's where there's like super low probability. Wherever there's a number, I mean, it is hypothetical.
Yeah, and
it can happen.
And every month that we really show these updates, you'll see these numbers are going to change, these probabilities. But that's where we're at right now. We see maybe rates going down about 1.25%. Potentially, the next year and a half. Okay, so if you look at this chart, it's showing the expected Fed rate, July 26th, September 20th, November 1st, December 13th. This is all 2013. And then once we hit 2024, we can see those rates, the expected rates going down. So we see the expected Fed rate maybe basically holding at 5.5%. That's the Fed rate. And then and this is just potential mortgage rates, if that differential between mortgage rates and Fed rate holds, maybe mortgage rates are going to stay between that in that 6.75% range.
So basically, the macro picture of this is if you look through over the next year and a half, I mean, we're hoping that the Fed funds rate, comes down almost 2%, and we're going to have a 5% mortgage rate.
Yes, by the end of December 2024, potentially a 5% interest rate. And if we look at the difference in mortgage payments, what does it look like on a $600,000 house?
So basically taking those interest rates and applying them to the same house at $600,000 today, going all the way to the end of 2024.
Yeah. And we see that the payments on those scenarios with some estimated tax and insurance on a $600,000 house go from $3,400, $3,433 at 6.75%, all the way down to $2,896.
Yeah. So what is that? $550 a month.
Yeah.
$550 a month.
Yeah.
Now, one of the things we were talking about is we haven't adjusted the actual sales price. So sales price could be, should go up.
Well, it might be, yeah.
Could they go down? Yes, they could. But again, we're just simply showing you what would a mortgage payment look like following the schedule we have of where mortgage rates are starting in July, moving through to the end of next year.
Yeah. And if you were to buy today, this is, payment would be here. If you refinance in the future, at the end of 2024, it could be potentially this number here, the 28.
Yeah.
You get $500 in savings.
Yeah. And I don't know if I like this, but people say, marry the home, date the rate.
Yeah.
I'm not like super pumped about it. But the point is that you won't have that rate for very long. Hopefully you don't have that $3,400 mortgage payment for very long, because look at where it's going to go.
All right. If you like what we're doing here, be sure to subscribe, comment, and like. And as realtors here in the Valley, there's so much information that you have at your, that you're trying to digest. We're hoping that this is something that you find useful. Be sure to email us, call us if you have any questions.
All right. Well, thank you.
Thank you.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.